Trump just made a promise that millions of Americans want to hear. A 10% cap on credit card interest rates for 1 year, starting January 20th, 2026. If you're carrying a balance right now, that sounds like relief. It sounds like someone finally stepping in to stop what you feel every month when you open your statement and realize the interest alone is eating your paycheck. On the surface, this feels like justice, but what if this promise doesn't make credit cheaper at all? What if it quietly makes credit harder to get, more selective, and more dangerous for the people who rely on it the most? Because that is the part almost no one is talking about yet, and it's the part that matters most. Over the last 48 hours, searches for Trump credit card interest have exploded. That doesn't happen by accident. It happens when a financial pressure point meets a political narrative at exactly the right moment. Credit cards are no longer just a convenience in the United States. For millions of households, they've become a survival tool. Groceries, gas, medical bills, rent gaps, emergencies, all of it increasingly lives on revolving credit. So when someone promises to cap interest rates at 10%, people don't hear policy, they hear breathing room. Right now, the average credit card interest rate in the United States sits above 20% according to Federal Reserve data. That's near record high territory. Some cards charge significantly more. Rates of 25 to 30% are common for subprime borrowers. That means balances don't shrink, they metastasize. Even disciplined borrowers find themselves paying interest for years without meaningfully reducing principal. And this isn't a fringe problem. Total United States credit card debt has crossed $1.17 trillion as of the third quarter of 2024. That number alone should stop the conversation. Over $1 trillion in revolving consumer debt is not a side issue. It's a structural feature of how the economy functions now. Trump's proposal, at least as publicly announced on Truth Social, is straightforward. Cap credit card interest rates at 10% for 1 year, starting January 20th, 2026. No long legislative explanation, no detailed mechanism for enforcement, just a promise. And promises like this spread fast because they tap into frustration that cuts across every political ideology. Conservatives, liberals, independents, everyone feels interest. Everyone understands the pain of paying money just to owe money. The appeal is universal and immediate. But financial systems do not operate on fairness. They operate on incentives. And that's where the story starts to bend in ways most headlines aren't explaining yet. Credit cards are not savings accounts. They are not utilities guaranteed to everyone. They are risk-priced lending products. Every interest rate that exists on every card exists to compensate for the statistical probability that some percentage of borrowers will not repay what they owe. That probability is not evenly distributed across the population. It never has been. Banks don't assign interest rates based on morality or compassion. They assign them based on credit scoring models, historical default data, and loss curves that have been refined over decades. High-risk borrowers pay higher rates because, statistically, they default more often. The higher interest collected from those who do repay subsidizes the losses that come from those who don't. This is the fundamental mechanism that makes unsecured consumer lending work at scale. When you impose a hard cap on interest rates, you don't remove risk from the system. You remove the ability to price it accurately. And when risk can't be priced, it doesn't vanish into thin air. It gets avoided. This is the first uncomfortable truth behind the applause and the excited headlines. If a bank cannot legally charge more than 10% interest, it faces a set of limited choices. It can reduce credit limits to limit its total exposure to any given borrower. It can tighten approval standards so that fewer people qualify for cards in the first place. Or it can close existing accounts that no longer make economic sense under the new pricing structure. Historically, when governments impose interest rate caps on consumer lending, banks do all three, not out of spite or political retaliation, out of basic financial necessity. Lower interest caps do not automatically mean cheaper credit for everyone. They usually mean cheaper credit for people who already qualify for low rates, and no credit at all for those who don't. The borrowers most excited by this promise are often the first ones excluded when caps are actually enforced. Lower income households, younger borrowers with thin credit files, people with past delinquencies or defaults, anyone sitting near the margin of credit worthiness. These are the people for whom a 10% cap sounds like salvation, but who may find themselves unable to access credit at any price once the policy takes effect. This is not theoretical speculation. This is historical pattern. Whenever governments around the world have imposed strict controls on consumer credit pricing, access contracts, lending becomes conservative, card issuers pull back from marginal markets, approval standards rise, and marginal borrowers, the ones who need credit most desperately, get cut off. When those borrowers still need money because emergencies don't wait for policy debates to conclude, they look elsewhere. Buy now, pay later programs that operate in regulatory gray zones, payday lenders, high-fee installment loans, pawn shops, informal credit arrangements with predatory terms, all channels that sit outside traditional banking regulation and often charge effective rates that are much higher, not lower, than what credit cards were charging. This is the paradox that almost no mainstream coverage is explaining clearly yet. A policy designed to protect consumers can quietly push the most vulnerable ones into significantly worse financial traps. It's a pattern that has repeated across countries, across decades, and across different types of credit controls. The outcome is remarkably consistent. Supporters of Trump's proposal argue that this time could be different, that the cap is temporary, only 1 year, that banks are profitable enough to absorb lower margins for 12 months, that the system will adjust without major disruption. And maybe parts of that argument hold some truth, but only at the very top of the credit spectrum. Prime borrowers with stable incomes above 6 figures, strong credit scores above 750, and clean payment histories may actually see real benefits. Their rates could fall meaningfully. Their balances might finally begin to shrink faster. Their access to credit will almost certainly remain intact because they represent the lowest risk segment of the market. But that's not where systemic stress lives. The stress lives at the edges of the credit system. It lives in households already stretched thin by years of inflation in housing, healthcare, childcare, and food costs. It lives in borrowers who don't use credit cards for discretionary spending or luxury purchases, but for survival. For them, access to credit matters more than the price of that credit. And access is exactly what gets rationed first when pricing controls are imposed. Banks and credit card issuers understand this dynamic far better than politicians or the general public, which is why the reaction from the financial sector has been cautious at best and quietly alarmed at worst. Not necessarily because banks oppose helping struggling consumers, but because interest caps fundamentally distort lending behavior in ways that are difficult to control or predict. When one lever in the system is artificially frozen, pressure doesn't disappear. It shifts to other parts of the mechanism. Fees increase. Rewards programs get eliminated or reduced. Credit limits fall across the board. Approval rates for new accounts decline sharply. Risk tolerance shrinks. Banks become more selective, not more generous. There's another critical layer here that makes this proposal even more fragile than it appears. Timing. This idea is being floated at a moment when consumer credit stress is already elevated and rising. Credit card delinquency rates have been climbing. Defaults are ticking upward. More households are relying on revolving credit just to maintain basic consumption and cover gaps between income and expenses. In that environment, banks naturally become more risk-sensitive, not more accommodating. Introducing a hard interest rate cap during a period when credit quality is already deteriorating doesn't stabilize the system. It accelerates the tightening process that was already beginning to happen organically. This is where good intentions collide head-on with economic reality. If credit becomes artificially cheap in price but simultaneously scarce in availability, aggregate demand for credit doesn't disappear. It migrates. People still need liquidity. They still face unexpected expenses. They still need bridge financing between paychecks or during income disruptions. When traditional credit channels pull back or shut down entirely, shadow credit systems expand to fill the gap. And shadow credit almost always comes with worse terms, fewer consumer protections, higher effective costs, and less regulatory oversight than traditional banking products. This dynamic is not hypothetical. It has been documented repeatedly across different countries and different time periods. Every time credit pricing has been constrained through regulatory caps without parallel mechanisms designed to preserve access, the market fractures. Formal credit contracts, informal credit expands. Access becomes a privilege concentrated among those who need it least rather than a broadly available tool. And once that fracture occurs, reversing it becomes both politically painful and economically complex. You can't simply remove the cap and expect the system to instantly return to its previous equilibrium. There's also a political dimension to this proposal that cannot be ignored if you want to understand what's really happening. Promising cheaper credit is easy. It generates immediate applause and widespread support. Explaining trade-offs and unintended consequences is not easy. It requires nuance, patience, and a willingness to deliver uncomfortable truths. The applause comes instantly. The consequences arrive later, often after public attention has moved on to the next crisis or controversy. By the time credit access begins to shrink noticeably, approval rates fall measurably, and existing accounts start to get closed quietly, the narrative has typically shifted elsewhere. The connection between the policy and the outcome becomes harder to trace in the public consciousness. That timing gap is critical. It means that politicians can claim credit for popular action while avoiding blame for negative results that manifest months later. It also means that by the time consumers realize what has happened, reversing course becomes much harder because the political capital has already been spent and the focus has moved on. This does not necessarily mean the proposal is automatically wrong or misguided. It means it's incomplete. Any serious attempt to cap interest rates on consumer credit would need complementary measures running in parallel, government guarantees or subsidies to offset increased risk, risk-sharing mechanisms between public and private sectors, alternative credit channels specifically designed and funded to serve populations that might be excluded. Without those supporting structures, the system doesn't rebalance toward a better equilibrium. It simply excludes more people from access. An exclusion in credit markets doesn't look dramatic or catastrophic at first. There's no crash, no breaking news ticker, no emergency press conferences. Exclusion looks quiet and bureaucratic. It looks like denial letters arriving in the mail, reduced credit limits with no clear explanation, existing accounts closed with minimal notice, people discovering, sometimes only when they try to use their card, that they no longer qualify for products they had relied on for years. Financial systems rarely fail loudly at the beginning. They fail quietly through accumulated friction, rising barriers, and increasing scarcity. This is exactly why the explosion of search interest around this topic matters so much right now. People aren't just searching for news updates, they're searching for reassurance, for clarity, for someone to explain in plain terms what this proposal actually means for their daily financial lives. Credit cards have quietly become a critical pressure valve for an economy where wages have stagnated for decades, while costs have risen relentlessly. Touching that pressure valve without fully understanding the complex system of forces behind it is genuinely dangerous. There's also a much deeper structural issue sitting beneath all of this. The role that consumer credit now plays in maintaining economic stability. Over the last several decades, access to consumer credit has quietly replaced wage growth as the primary shock absorber in the economy. When income stagnated and stopped keeping pace with productivity gains, credit filled the gap. When the costs of housing, healthcare, and education rose much faster than median household income, credit smoothed consumption and prevented immediate crisis. That system is fundamentally fragile. It works only as long as access remains broad, continuous, and relatively friction-free. A blunt interest rate cap imposed without careful design risks disrupting that equilibrium without offering any replacement mechanism. And when equilibrium breaks in complex systems, it rarely breaks evenly or predictably. The most financially resilient households adapt quickly. They find alternatives. They adjust their behavior. The most vulnerable households, the ones operating closest to the edge, fall through the cracks. They lose access. They turn to worse options. They spiral downward faster. So yes, a 10% interest rate cap sounds great on its face. It sounds fair. It sounds like someone finally standing up for ordinary people against powerful banks. But finance has a long and consistent habit of punishing policies that focus exclusively on desired outcomes while ignoring the underlying incentive structures. Price controls don't eliminate costs. They move them around. They hide them in different places. They delay their appearance. And very often, they concentrate costs exactly where people can least afford to absorb them. The real risk emerging from this proposal isn't that interest rates stay high. It's that credit access narrows dramatically. It's that the system becomes something you can qualify for only if you're already financially stable enough that you don't desperately need it. This is the hidden trap that gets missed in the excitement of the initial announcement. The next phase of this story won't be decided by political speeches or enthusiastic headlines. It will be decided by actual behavior in the financial system. What banks do, not what they say publicly. Watch approval rates carefully over the next several months. Watch credit limits, both for new accounts and existing customers. Watch which demographic groups and which geographic regions see accounts closed first. Watch where fees suddenly increase to offset lost interest revenue, because that's where the real impact will show up first and most clearly. If access starts shrinking quietly in the background while interest rates fall loudly in the foreground, you'll know exactly how this story played out. You'll see it in the data before you see it acknowledged in the political narrative. And that brings us directly back to the question that most people aren't asking yet but need to start asking immediately. Not whether credit should be cheaper. Everyone agrees it should be. But who will still be allowed to have access to it at all when the rules change suddenly? Because in finance, price is only part of the equation. Access is the real source of power. Access determines who can smooth consumption during income shocks, who can handle emergencies without catastrophic consequences, who can invest in education or training or relocation, who can take calculated risks. When access becomes restricted, all of those possibilities narrow, and they narrow fastest for people who have the fewest alternatives. This is not about defending banks or arguing that high interest rates are good. It's about understanding that crude policy instruments applied to complex systems produce results that are often the opposite of what was intended. History shows this pattern clearly. Economic theory predicts it, and the current structure of consumer credit markets makes it almost inevitable. Trump's proposal has triggered a massive wave of public interest because it speaks to real pain and real frustration. Credit card debt is crushing millions of households. Interest charges are brutal. The system feels rigged and unfair. All of that is true. But the solution being offered might not actually solve the problem. It might just transform it into a different problem that's harder to see but equally damaging. Expensive credit that you can access is often better than cheap credit that you can't get at all. The coming months will reveal which version of this story becomes reality. Whether banks find ways to adapt while preserving broad access, whether complementary policies emerge to support the cap, whether unintended consequences spiral into something worse than the original problem, or whether this becomes another example of how good intentions in financial policy can produce outcomes that hurt the people they were meant to help. For now, the promise sounds good. The headlines are positive. The search interest is massive. But the real test hasn't started yet. The real test begins when the cap takes effect, if it takes effect, and banks start making the hard decisions about who gets credit and who doesn't. That's when we'll know whether this promise delivered relief or just shifted the burden to a place where it's harder to see, but impossible to escape. Watch what happens next, because what happens next will matter far more than what was promised today.